guys are the diehards of the group. I just wanted to make sure I'm recording. Sorry for my hesitation there. So yes, it's Friday and it's a holiday, and you guys, the true entrepreneurs of the clan, are here. Thank you for being here. If you are watching this as a video later on in the day, thank you for watching it later. I think this is really good of you to establish your boundaries when it comes to holidays, but I want to go through our last day because this is an important day, wrapping up, tightening up all the loose ends and dotting the I's and crossing the T's like we talked about yesterday. So I want to walk you through kind of the final process that I typically go through with a client after we've done all the work that we've done together, right? We've done all the historical data. We've done our kind of our first draft of our planning for profit. We've done our weighted business model, our cost of goods. Yesterday you did the marketing mix, being able to defend the sales. So now I want to walk through, now that you've done that, we're going to come through, tighten some stuff up. I'm going to take you step by step what I go here through with clients so that you can see this process for yourself. So that you're aware, excuse me, this isn't the best color. I tried to find a color. I started with red and then recognized 3/4 of the way through that red is typically indicative of negative cash positions. So I thought that was a poor choice. So I moved to blue. So hopefully you can see this. It's not the best, but it was the best I could find in the situation I was in here. So you may recall the first thing you're going to go through is you're going to go through your revenue streams. And like we talked about, not yesterday, but the day before, that if some of these projects of yours, if some of these revenue streams are phased out, works in progress, or you've got a deposit and then due upon completion, right, we can start to break those out a little bit more. So rather than me doing it live, which I attempted to do with you a couple of days ago and got all flustered, which is what happens to me, I took some time and just mapped these out a little bit cleaner and nicer for you. So what is going to happen is that when you break this out, so for example, I've got custom home deposits, custom home mid-project, and custom home final project, right? So instead of just being custom home as one line, I broke it down into 3. The next thing I changed down here is I changed the amount, right? So for the deposit, you get $50,000. For mid-project, I estimated 150, and then for the final payment, it was 300. So however that works for you. Now, I didn't change this. Sorry, what I should have highlighted up here is that I did change when I received that money. So here, I put one deposit came in October here. So it comes in, right? And then I get my 50,000. The next progress-based billing came in over here. What month is that? April, right? So that one payment came in of 150, which equals 150 revenue. And then the final payment came in down over here somewhere in August. So what is happening is when the revenue is received is changing in your cash flow, but it's still the exact same amount, right? So you don't need to worry so much about your profit when you come back and finesse this, because again, your revenue targets, your revenue stream, your income is not going to change. It's just when you receive it that is changing. The next thing I want you to do, again, depending on how comfortable you're feeling with everything, if you're not super comfortable with it all, I'm just going to get you to keep your cost of goods at 85%. Again, this will not adjust anything, right? So you may recall that when we did the custom home, it was 85% cost of goods. So we're still saying that 85% of $50 or 50,000 is 42,000. So again, this is not going to adjust your totals. It's just adjusting what's happening in those specific months as it pertains to when that revenue is coming in. So that's the first thing I want you to do, is just go through that and make sure that all of those are aligned. The next thing I need you to do is that once you understand your income, and you know, making sure that it's being received in the right months and the deposits and the payments, the next thing you do is you come down to expenses and you make sure that everything is in alignment with the income pieces. So specifically what I want you to think about is heavy flow, right? So heavy seasonality. So in this construction business, you will see that there's a lot obviously going on in spring and summer. So I want you to think about when these periods happen in your business and there's a lot of activity, what needs to happen on the outflow of expenses, specifically in the area of team. So if you're in a retail business and we know that you are going to be heavily weighted with respect to activity in maybe October, but November, December, Boxing Day for sure, I would expect that your team, I'm going to see some increases in team to make sure that you've got the right support, operating support, not cost of goods support, to be able to support the sales that you have projected for those months. Does that make sense? So usually team gets impacted. So in this case, you can see that I added for these guys office support for those months where they are flying high, like they have, you know, back-to-back projects. That's when all their projects are. So they brought in just some part-time office support here as an example. So as I put those numbers in, absolutely, right? We now have an extra $12,000 that we've added to our expenses. So let's tweak that. So that's a little bit of tightening and tweaking. Under space and operating, again, do you need to make adjustments depending on flow? Maybe on some of the lighter months, is there anything that you can do to lighten up some stuff? Maybe your utilities might not be so high, your fuel might not be so high, whatever it may be, right? But are there expenses that we need to budget for? So in this case, I added for shop supplies, right? Smaller shop supplies, they're gonna have to divvy out more stuff to more men. So I added some incremental costs in there for them, $2,500. The next thing you absolutely need to do is add that marketing mix, expense, and budget that we talked about yesterday, right? You went through a marketing mix for each product and service. I did not break them down here. I just put them in one bucket called marketing mix. And in that marketing mix, you'll see that I now have that on those months, we had 6,000. You might recall before it was flat of 5,000 going across. Now we have some variance, right? 6,000, 1,000, 2,500, 2,500. This is the number that defends the marketing plan that you had put together yesterday. Also, I added a few more things in here, business cards, material. You know what? This is the time for you to add it. We can still tweak, right? So I added those things in there. And then also recognize signage expenses. So I added extra signage for when they have those projects, which obviously actually should be bundled into cost of goods. But again, this is going to be a work in progress for you as you start to understand these things. So when I say signage, I mean, you're probably very familiar when a house is being built. There's usually a big sign that's on the front yard saying, you know, proudly constructed by. And so for each one of those projects, there's a sign budgeted $500, not per sign, but for that month for all the projects that they have going on. So again, just made those adjustments. The other thing that I want you to think about, and this is going to be different for each one of you, but if you are a retail business and you have to invest significantly in inventory certain times of the year, I need you to think about adding some other expenses here as upfront costs, right? Because you might need to, you might be buying, I know we've got some members on the line that this applies to them. You might be buying spring patio furniture, summer patio furniture right before Christmas, right? And you might need to invest heavily in that outside of what you're actually receiving from your cost of goods in these respective months. So I just want you to be able to budget for that there. Now, I just remembered two things that I did want to speak to you about is one thing is discounts. And we've got a member on the line that this applies to her. I actually also just finished working with a client that they discount everything. Everything in their business is discounted. I'm not a fan of discounts for a couple of reasons. One is that it obviously discounts your price, and it also discounts your perceived value. Yeah. So not a fan of it. However, if you're going to do it, and the client that I was working with is a membership-based model. And so they offer discounts when somebody buys the membership, which is great because there's very little cost of goods associated with it, right? So they've got that membership, so that's recurring revenue that's coming in. But when they buy the membership now, there's a discount on everything. So if you've been in business for a while, and if you recognize that, you know, almost 80% of your business is from people who hold memberships, I want you to start looking at your cost of sales model, your pricing, step 4, right? Pricing for profit. And I want you to add that discount in the price, because we should never compromise on our bottom line. So if you're taking 10 to 15% off the top, you need to budget for that in your pricing. Very similar to what we did with the construction guys, where they're handing the rebate check of $1,234 at the end of the project, but they've bundled that in their cost of goods. That is not coming off of their product. They've already planned for it. So that was step 1 on discounts. The other piece I wanted to mention here, and I apologize, just under revenue streams, if you are a membership-based business, or if you have memberships, or if you have any form of reoccurring, I just really want to make sure that you are well aware of the cumulative impact. So for example, if you sell, let's say down here, other is a membership. If you are selling one membership, as an example, in October, in November, you sell one as well, right? November would actually show 2, because if these are reoccurring, if you're selling one in October and it's at $25, and then in November, you sell a second one at $25, now you're actually getting $50. So this line should be 1, and then it should be 2. And then if you're planning to sell 3 in December, now it should be 5, right? So I just wanted to draw your attention to that cumulative impact, if that applies to you in your business. So in operating expenses, again, what I want you to think about, do you need to make adjustments to team, either increase or decrease based on your flow? Do you need to make adjustments in your operating expenses or production expenses, right? Decrease or increase based on flow. Sales and marketing, you carry the marketing mix over, and any other expenses that you feel might be attached to the big volume, the flow that you've got with respect to the revenue, I want to make sure that you can account for this here. Okay. So that is it for making the adjustments there. Now you will notice that once we make those adjustments, there's really been no change to our income, right? So we are sitting at 3.5, and for those of you who have been paying close attention to my work, you will notice that when we did this before, it came up with a 4 million. It is because there were definitely some adjustments to be made, but it's because when I had used this before in the past, one of my formulas was off, as an example to a customer, a client. So we still needed to make some minor adjustments here, but we did not need to grow by a whole million. So I still want to prepare you that you will need to make minor tweaks and adjustments when it comes to your bringing over those plan for profit numbers, but they're not going to be out of whack by $1 million there. So, all right. So your adjustments, right? Your revenue is going to stay very consistent. If we look down here, you might incur a few more expenses, right, as a result of doing that. So again, we just need to look at the bottom line and see exactly where we end up. And in this case now, we are ending up at 13.76. We actually save some money, because remember I asked you all to put aside a pretty hefty number for your marketing mix. Now that you go back and you take that out, right, or you adjust it, you might be saving quite a few dollars there. So depending on how this works out for you, I want you to always just make sure that you are at least 10% net profit. Absolutely, without a doubt. Okay, now the next thing I want to show you, which is very important for your sustainability, is what I call working capital requirements. So now that we've done all of this work, I am going to get you to look at, your net profit for sure, right? Your ins and outs. And I want to draw your attention to, when you are looking at these numbers, I don't want you to panic when it comes to net profit. If you see a red number, which means you're in a negative, right? There's brackets beside it and it's in the red. If you see that, do not panic. This is expected in business. It's in retail, you know, that day Black Friday, right? In November, it is called Black Friday because it is usually the first time in the year that retail businesses actually see a black number with respect to their net profit. They're actually in the positive. because they carry the negative all throughout the year until all of the volume comes in, but they make up all of that money for the most part, again, why it's Black Friday, in November and December, and then that carries them for the year forward. So I don't want you to worry about red numbers up here. Where we cannot have red numbers, where you cannot have red numbers in your cash flow, is down here under cumulative cash flow. Because the cumulative cash flow, so that you are aware, this is your bank account, AKA bank account. And unless you have an overdraft, and I don't even want you to bank on the overdraft, we want to make sure you have enough money in the account to operate in a healthy position, right? So that you don't start to panic. This is where the panic sets in. This is where the stress and the anxiety and, oh, what are we going to do? So if we look at this at a quick glance and we just go across, black across the board. So it's like, okay, feeling pretty good. Now you are going to see here that there is 1 month. Can you, what month is this? October, November, December, January, February. This business is operating with $1,500 in the bank. A little lean and mean, especially when they've got a burn rate, general expenses of about $32,000. So this is where, when you start looking at these numbers are a really good indicator of potentially you needing to, and especially the buffer that you need to get your sales to this position. But being able to go to the bank to say, I would like to negotiate a line of credit or an operating line. In this case, if I were to see these numbers and this was my client, I would ask for an operating line of at least $60,000, 2 months, if not 90. Really, I'd say 100,000, go in at 100 and see what they come back with. An operating line, you do not get charged interest unless you actually draw down from it. Now, to get that money, you have to go in and you need to present everything that we've just worked on, right? You need to show them your cash flows, your pricing strategy, your cost of goods, your equipment costs. I tell you, when you go in, it's like the little investment angels start to sing, because it's like, oh my gosh, they know exactly what's happening, especially when you go in with your marketing plan. It's exactly how we're going to make these numbers. And then you just explain to them, there's a couple months that we're a little tight here, specifically this one. I'd like to ask for this. Are you comfortable with it? See what they come back with. So this is what we call working capital requirements, that you have enough money in your bank to make sure that you can sustain in the event that something happens. But again, remember too, that I've asked you to all budget for contingency funds here. In this case, it's $1,000 a month. That's probably low in proportion to what these operating expenses are. I probably should have budgeted more like $5,000 for them, but everybody's different, right? Everyone's got a different situation here. So I wanted to draw your attention to that. The last little piece that I want to draw your attention to is this little 0 right here under cash from previous period. So that number is, if we look at, and I don't know when you have started your cash flows, but if you look at how much money is in your bank account minus any outstanding accounts payable, right? So your cumulative cash position, I want you to write that in here. So if you know that you've got $25,000, now in this particular example, you may recall that these guys were hemorrhaging money, right? I think they were, what was it, $400,000 short that year. So they did not have a lot of extra cash lying around. But if you have any cash that has been set aside, not in your savings, but in your operating account, you can put it in here. So that 25, you can see right away that adjusts that month that we were really tight for 1,000, because you already had 25,000 in the savings account, or in your operating account, excuse me. So basically all this is it's saying your net profit plus whatever was in your account from the month before now equals what's in your account this month. And that is why here in November, we go from 120 and we dropped to 89, because we were a negative net profit that month. Negative net profit again, we dropped to 58. Negative net profit again, we dropped to 26. But then we start growing, right? So then we grow to 213 in our account, then 422, then 536, 575. Oh, we have a bad month again, but we've planned for it, so it's not bad. It's just no projects, right? 535 at the end of the year here. We've got 513, and where this adjustment, here, if you're thinking these numbers aren't adding up, it's because of the $25,000 from the cash that you started with. That's why those numbers are different for you. Okay, so we've got working capital. I went through that. Okay, last little pieces I want to show you. So now that we've got all of that set up, and you can see that that cash from previous period, it does not adjust your profit margin. Your next step is to go to benchmarking for profit. Now, this is a tool that I encourage business owners to use regularly, and to make sure that their bookkeepers are giving them the data that they need to be able to, you just pop it in here. Even your bookkeepers can pop these numbers in here, and then you assess exactly where you're at. These numbers that I've put in blue, I simply carried them over from the percentages that are in each of your sheets here under forecasting for profit. So these become our new benchmark, right? So we know that we're looking for this to be a portion of our revenue, and these can be adjusted. But again, remember, if you're making adjustments, if things start changing for you, I want you to understand the consequence of that on your profit. Because again, remember, custom homes, we're only making 15% net profit. So if all of a sudden these guys start moving up into 50, 60% of their revenue is from custom homes, I'm going to start to say, you know what? Are we losing 15% of our net profit? Because is that taking away your time from these other renovations here? So you just need to check in on this. But what I love about this exercise, now this is going to be, it's going to be more of a challenge to manage if you are project-based, because the variables in a project, and when you spend money on procuring materials and labor, and then when that money is received, it's going to be kind of, woo, what's going on? If you're product-based, this is going to be very, very simple for you, right? So you can tell throughout these last 10 days, there's pros and cons to each model. You just kind of have to take them as they come. But one thing you can definitely lock in on down here is your indirect costs, because these are also, remember, known as fixed costs. These should be trending at your percentage points, because if they aren't, you have to fix it in that moment. And you can either fix it by reducing the expense, or you're going to have to up your sales volume somewhere, because your cost of goods is going to remain pretty static. So you either up how much you're selling, or you're going to reduce the expenses if these numbers aren't in alignment. So this is the benchmarking for profit tool that I love to look at on a consistent basis, probably monthly, just to make sure all the percentage points are lining in. And then here's another tool for you. And these are obviously just, if you feel these work for you, you go ahead and do it. This one I created because there was one member who she was on it every week. She had a team of 14. She wanted to be able to show them exactly where they were at with respect to their sales primarily, but she started to definitely track her expenses down here. So how this works is you just put in your revenue stream, and this is going to be your step 6. It's in your worksheets. So you put in your plan. This is your monthly plan. So total revenues, you don't touch total revenues. You just put in your stream 1, 2, 3, 4, and then you're going to get a total. And as always, we're going to get 100% of total sales, right? Is 100% of total sales accounts for all of these revenue streams coming in. Then what can happen here? Week 1, right? So very similar. This is kind of your benchmarking for profit, but on a monthly snapshot. Week 1, you will put in your income that's coming in, and these percentage points, just so that you know, these are a percent of your revenue. So you can see if numbers are off or in alignment, what's happening there. But again, don't panic too much in week 1. What happens here, what I want to show you at the end, is that you have a month to date. So now if you start to add to week 2, you're probably going to be like, well, you know, it's easy to tell in week 1, but week 2, where are we at to plan? So you're going to get a month to date, what your total sales are. And then over here, this is a variance to plan. So for example, in week 2, let me add something here. Let's say in week 2, we actually get another $10,000 in, and here we get another 1,000, and here we get another 1,000. I'm just throwing in some numbers so we can see everything adjust. So now over here, so month to date, we're at 35,000, 2,002. So where we're at to plan, right? We're actually down 65,000 to plan in revenue stream number 1. We're down 8,000 to plan in revenue stream number 2, and we're down 3,000 to plan in revenue stream number 3. So here your variance to plan, you're at 35% of plan, 20 to plan, and 40 to plan. So this helps you definitely if you've got a team that you need to start communicating with, right, that are accountable, or your salespeople, however that's going to work. But again, you know, whether you want to show them all the numbers, like all the expenses and everything and net profit, that's completely up to you. But again, make sure your bookkeeper has the tools to be able to help you input the data into a system that you can use so that you can make really sound management decisions going forward. Okay, I think that that is it for this exercise. So we went through all of that. So in closing, this is our wrap up. I want to applaud all of you. You all get high fives. You have stuck it through. This is not easy work. It's not easy to even think about, let alone to show up and do it. So really, you make sure this weekend you celebrate the fact that you had the courage to do what you're doing here. What I do want to say is I'm going to be following up with each one of you. I really, from the bottom of my heart, from the top of my heart, I'm going to have to look at that saying and why we say the bottom of my heart. But I am genuinely, authentically so grateful that you had the courage to go through this with me. This is my first time doing it online. That's my daughter that you just saw. And you know, I haven't done this before online. It's always been boot camp and it's been one-on-one. And I have definitely made some mistakes as we've gone through this, and some template errors that usually I can catch when I'm working with a client. So thank you for your patience. Thank you for your trust in me with this process. What I want to offer you is, if you ever need to do this again, I'm going to do the next one, not next month. I obviously have a lot of tightening up to do, but the next one I'm going to offer in June. I think it's June 10th. So it'll be the second Monday of every month. And my offer to you is that if you want to do it again, there's no charge. You just let me know and I'm going to send you the link so that you can have a refresher, and it'll probably be a little neater because it'll be my second time doing it. So I'll let you know about that. But I do want to follow up with each of you personally, because I would love to hear from you what had the most impact, what was really confusing, what did you get no value whatsoever out of, because that helps me obviously to build them going forward. As I mentioned before, the Planning to Profit Equipment Room will always be open to you, so don't feel the need to rush and download all of the tools. Actually, we'll probably continue. I'll add more tools as I go through these challenges. Feel free, please, to refer anybody into the program that you think would benefit from it. And then the last little piece is just, you may have heard me speaking a little earlier to a member as well about this. So I have been working with entrepreneurs on the mechanics of money for over a decade now. And I realized about 5 years ago that you can have tools out the wazoo, right? We've just gone through it all. We can do this, we can do a whole bunch of other stuff, valuation strategies, right? Like we can do it all. And what oftentimes happens is that we don't understand that it's our own mindset really that is blocking us from doing the things that we need to do, because you know what price to charge now, and you know how many calls you need to make to get the sales in. So if you're going through this process and you start to stumble and you're like, oh, I'm so uncomfortable charging the price, I just can't do it. Or, oh, I don't know how to pick up the phone and create awareness, just awareness, because I'm not sure my product's there yet. I need to make it a little bit more perfect, right? It's not perfect, it needs to be better. I need to make more adjustments before I get that out there. If any of this is you, if you're not taking a salary and you're like, the business just can't afford it yet, I'm going to tell you right now that even if your business can't physically afford paying you, you should be taking the money out of the business and showing a shareholder loan and then putting it back in, right? That's money that the business owes to you. Not getting paid is not an option. It's just a different way to recognize that payment. So the business still owes you that. But right now, that is not what is happening, right? If you're not taking the salary, it's a whole different dynamic. But So my offer to you is this. Every month I offer a 21-day challenge. It's called the Money Mastery Matrix, and it's for entrepreneurs. I created it for entrepreneurs. It's for anyone, but I'm going to tell you, we take a look at personal finance, because your business finances are a mirror of how you manage your money at home. It's the exact same thing. So it breaks down into 3 weeks. Week 1 is all about personal money management. We build a personal budget. You may have heard me in day 1 and 2 talk about magic numbers. That personal budget actually shows you how much the business needs to be paying you every month so that you can invest properly, so that you can share properly, including tax payments, so that you can put aside a nest egg, a safety net, right? And that you are living life with joy and with happiness, and you can buy things that you want to buy, not necessarily that they're frivolous, but all of those numbers, that's your magic number. That's what we carry over here. The other piece is the investment nest egg. So in week 1, we're going to figure out exactly what is the gap between what you currently have from an investment strategy towards what you need. Your business becomes your investment nest egg. Your business becomes the strategy. And this is why your net profit is so important. And you've heard me talk about this before, because your net profit, what your ticket price typically that you are going to get on your business, if you've even thought about selling your business, if you've even thought about your business as an investment, this might just blow your mind if this has not been where you're at. But your net profit is what we talked about this, what you would get from any sort of investment that you would put in the market, right, in terms of annual return. And the second piece is that when you go to sell your business, once you've created this structure that is so solid, right, and you can pass this on, typically the value of the business outside of assets is going to be a multiple of your net profit. This is the other reason why we plan to profit. So once you know what you need for a nest egg, right, this business should tie into that. Hopefully it does that and so much more. But a lot of people don't even see their business as an investment. So week 1 is just all about personal finance. Week 2, we get into mindset. So it's understanding your programming, because 95% of the decisions that you've been making in your business have all come from your subconscious and you're not even aware of them. It's crazy. So your subconscious is trying to keep you into a state that it is familiar with, and that might be overwhelmedness, debt, right, indebtedness, stress, anxiety, fear, apprehension, whatever the feelings are. So we need to uncover what our program is so that we can change it. And then week 3 is all about motive and understanding the real reason why we're looking to do what we're doing, because most of us aren't even aware of what that is. And once that lines up for us and we stay consistently in alignment with that, amazing stuff happens. We actually just did our drill this morning at 8 a.m. and people were sharing what was actually showing up for them this week. And it's crazy. Like once you start getting into alignment with this, it's a beautiful, beautiful thing. So I'm going to share with you an invitation to participate in that. I have them every month. The first Monday of every month. Might not be live at 8 a.m., but there was always going to be a live daily, not a daily drill because that's in the video, so you'll have to excuse me, this is all new language for me, but there will be a live check-in every day, different times so that different time zones can actually weigh in. We've been having a couple people from Australia participate, and it's a lot of fun. Okay, so I'm going to leave that and leave that in your court, but I am going to be personally following up with each of you just to get a sense of where you're at. I am going to email all of you a follow-up email, and in that email, I am going to include a link for a 15-minute session. And it's not that I'm greedy on time, it's just that if I do a 30-minute session, we don't need it all. So I'm going to be mindful of my time. You mindful of your time. You can use the link however often you want. But I find that when you know that you only have 15 minutes, we usually get right to the point of what needs to be fixed, and then we get to fix it. So I'm going to send you that link. So if you want to connect to follow up on any of the work that you've done here, make sure you've done the work and attempted the work, because it's going to be a lot easier for us to look at the glitches and fix them going forward. Okay, I think that's it for me. I am going to, I'm actually going to turn off the recording now. So I'm going to say goodbye to those of you that are watching this later, but I am going to shut off the recording and then I'm going to unmute the participants on the call for any questions that you may have, but today's a little different with respect to shutting off the recording. All right, so for those of you that are tuning in later today, thank you again. You'll be hearing from me soon. Enjoy the exercise, and for those of you still on the call, feel free to come in with your questions in about 3,